Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Coreweave actually in positive territory now, just around $40.55 a share, so up about 1%. We're going to keep an eye on this one, and we're going to get into it a little bit more deeply in just a moment. First up, though, as Charlie mentioned, you heard stocks are down overall, bonds up following today's batch of U.S. economic data that showed a pickup in inflation, weaker than estimated spending, and the latest update to the Atlanta Fed GDP now pointing to a negative growth in the first quarter, even after adjusting for gold imports. It was revised lower to down 0.5% from up 0.2% previously after today's weaker than expected spending data. We needed to do an economic roundup.
So we got the guy with us to help us with that. That's Bloomberg News International Economics and Policy Correspondent Michael McKay.
Cowboy to do the economic roundup.
Well, you were just in Houston.
Dallas.
Oh, I'm sorry.
Close.
Dallas people they wouldn't like that.
I was thinking of your Boston Red Sox, right?
Yes, they're in Dallas,
okay.
And they won last night. So
okay, good. That's what we care about. Okay. Do we have a problem?
Well, now you can use the NASA thing, Houston.
Carol had that written in there.
Yeah.
We're trying to get there, Mike. Do we have a problem though?
We have black clouds on the horizon, put it that way. We don't know if the storm is going to actually hit, or if it does, how bad it's going to be. But definitely we saw weakness in spending. The spending that we did get up 0.4 for the month after 0.3 decline in January. Basically was in durable goods. So you get the impression that people were pulling forward purchases, trying to get ahead of tariffs, which is probably also the story that we saw in the Michigan sentiment numbers today. This was the final update. We normally just talk about the preliminary,
right,
and that doesn't usually move much. But this time we saw a drop in the headline number, and a drop in expectations fairly strong to 52.6 from 54.2. So people think there's going to be a problem 6 months from now, and you can see that reflected in the inflation expectations numbers.
Which was the most important data point that we got this morning? Which one's the one moving the markets right now?
It's probably the inflation ones.
But that's interesting because when those came out, we didn't see... I mean, when the market opened, it didn't seem like the market moved a lot. The equity market, at least, didn't move a lot until 10.
Well, that's what I mean. The inflation expectations numbers.
Oh, the inflation expectations.
Not the inflation numbers.
Okay.
We got basically what was expected with the PCE, because that's an indicator that's the way it's put together. Economists can forecast it pretty accurately, and it was only off by 1/10 in the core on a year-over-year basis. So it was the inflation expectations numbers on a one-year basis. People think inflation this year is going to be 5%, and 5 to 10-year inflation is going to be 4.1%. These are significant moves, and I wouldn't think the Fed is terrified, but they're keeping an eye on this. They don't want inflation expectations.
Mr. Mike, can there be 5% inflation?
Oh, sure. This is only the highest level since 2022.
Yeah.
Remember, we had 9% inflation. And that's part of the thing here, is that people think this is possible because they saw it happen. And so now the idea is, we're going to get tariffs. It's going to be a tax on everything we buy that's imported. And so people are thinking, well, I'm going to be paying more. And the more I hear about it, the worse it sounds. Especially, you got Donald Trump saying 25% tariff on imported cars.
Right.
And a lot of the American cars we buy come from Canada and Mexico. The American marks, put it that way.
Is that what is attributing to higher inflation expectations? Is it just tariffs?
It's basically tariffs. We haven't seen any real inflation news in the actual inflation figures that would move people's expectations. In general, inflation's been coming down. It's gotten stuck a little bit, but it's not moved up significantly. So you got to be looking at the headlines. for what's going on.
One thing I do wonder is how quickly do we start to see the actual tariff impact in economic data points? I thought I heard something this morning on surveillance that said it takes a few months for it to work its way in. So when will we start to, because right now a lot of it is sentiment, right? Concerns about things. But when the reality hits and we see those prices, like when will we see that?
Well, I would look for it sometime in the summer. You get the tariffs on automobiles. Dealers generally have about 2 months worth of inventory in their lots on a rough basis. So they'll sell through those, and then when you start to get replacement for those, the costs will have to go up. The same thing with the other tariffs he's going to put on next week. We don't exactly know what they're going to be, but suppose he puts on tariffs on fruits and vegetables from Mexico. Depending on when those tariffs become effective, you'll start to see those sooner than you would other things. And then there's the intermediate goods, the stuff that goes into other stuff that comes into the country, and that'll just depend on how soon it gets put in and how soon those things go on sale.
All right, we got to leave it there. That is certainly, though, something that investors are keeping an eye on, all of that economic data. Mike, thanks so much. Have a great weekend. Bloomberg News international economics and policy correspondent Michael McKee. So that is the key economic news you need to know, and that is certainly impacting today's trade. We've got another big indicator of market health here in the United States.
And that takes us to the highly anticipated IPO of the Nvidia-backed Coreweave. Coreweave shares opened up at $39. It was 2.5% below the IPO price, up 2% though. Right now, just in the last 9 minutes or so, Carol.
Yeah.
They went from the red to the green. The offering did raise $1.5 billion, 37.5 million shares priced at $40 a piece. The deal was downsized, though, from an initial plan of 49 million shares. Who is said to have bought the shares? Also super interesting. So let's get into all of that and more with the dynamic duo of Bloomberg News US IPO and deals reporter Ryan Gould and Bloomberg News equities reporter Bailey Lipschultz here in the studio. Bailey, on the price action, why did we see the reversal here?
Probably bankers utilizing the green shoe. So especially with a deal like this. So you kind of use the shares. With the thing with it, when you do an IPO, you sell a bunch of shares and then banks can buy other shares at the IPO price. So typically the whole mechanism operates to basically give some form of balance with the deal. So I was talking to a few bankers away from the deal.
Sounds orchestrated to me.
It's orchestrated. I mean, don't ask Bill Ackman about it. He has some pretty strong thoughts on it. But I was talking to a banker away from the deal, and he was basically saying when you see a deal like this where so much of the book, as we've reported, has been allocated to a handful of investors, people will get jittery. So if you see the stock dropping and you're a hedge fund who bought this to make a quick buck, you want to get out as quick as you can. And then the banks will wait for that kind of rush of volume, help stabilize the price, and then that can set up for, down 2.5 to up 2.5, but still marginal.
Is that not normal to have, half of the book allocated to the three largest investors?
That is tighter than I can think of in recent memory. We normally will have some deals that they call them clubby. But as we reported, half the book to three investors, so $750 million of stock chopped up. And then if you look even further at our reporting, top 15 took 90% of the deal. So very tightly allocated to almost friends of Morgan Stanley, if you will.
All right, clubby, friends, all that good stuff. Having said that, Ryan, going into this, it was downsized. So we had reduced expectations going into it. Based on that, and we are now showing a little bit of a gain, is this a good debut, a bad debut? Or neutral?
I think it's probably slight. I don't want to be that person, but I think it is still slightly too early. Let's see where we are at 4, because I think, to the green shoe point, sure. But I was also talking to Michael Intrato this morning, the CEO of Coreweave, and he was quite quick to point out, aside, away from the noise that we've seen this week in markets, and just given where the Nasdaq is and the S&P is today, Coreweave is not like most other tech companies that some of these investors, would be putting orders in for. I mean, his view is that it's quite capital intensive. And it is just based on the business model of Coreweave. And so his view in telling me this morning on the phone was that investors are going to take some time to actually get their heads around how we do things. And, it's going to be a little bit of a process. So I think you could probably see some volatility for a period. And, we're at, 40.91 now. It is conspicuously in that $40 area, the price there.
Is that just CEO speak? To explain maybe some of the difficulties? Forgive
Ask him,
me.
Carol.
I don't, how should we, we're smart here at Bloomberg. How do we read that?
And, and I put that to him. And, I think there's a lot going on. I mean, you've obviously got the Microsoft headline this week, which we spoke about yesterday. But then at the same time,
their biggest customer.
It is, yeah, and you would have to imagine in there among that sort of taking 50% of the book too. I'm sure in and around that area. And I actually put to Michael in this morning around sort of the Nvidia angle, and again, away from some of the noise, he said that without Nvidia and without the other 27 investors, this IPO wouldn't have got over the line.
Interesting.
So
Okay.
why did they do it then? Or is it because they knew they had those backstops?
I think for a company like Coreweave, the thesis is quite clear. It's just it's a valuation mechanism right now if you're an investor, because I think the free cash flow is very good. I mean, people are generally quite comfortable with the leverage, but it's always coming back to sort of some of the concerns around the customer concentration. And they're quite quick to point out that the OpenAI contract that they agreed quite recently, almost $12 billion is a boon, and it is, but at the same time you're still faced with 77% of your revenue on paper coming from essentially 2 customers. So regardless of what sector you're in, whether you're AI or otherwise, people are going to look at that and think, is that okay for us? And you take a view, right?
Yeah.
Bailey, even though this is a little bit different of an IPO, it's certainly a canary in the coal mine or some sort of bellwether for other companies that are on the sidelines right now thinking about going public. What's at stake here?
A lot, but also not a lot. Okay. So put it this way: the biggest
The liberal arts answer. I like it.
the biggest IPO of the year was Venture Global. Similar downsize, cut the book by about 40%, priced poorly, traded poorly, down north of 57%. When I talk to bankers and investors, they were vocal. This is a one-off. We're not worried about it. This deal comes out. Talking to bankers yesterday, we're not too worried about it. But it begs the question: when will people be worried about it? Because when you have 6 of the 10 largest US IPOs year to date trading below offer, you can point to the market being down as much as you want. But at the end of the day, people buy IPOs to outperform the market.
Right.
If you're not getting a day one pop or even a month later outperformance, that starts to make people second guess, why am I going to allocate resources to a private company that I've maybe met once or twice when I can buy your direct peers at a discount? And that's kind of what's been playing out.
It also makes me wonder, at Bloomberg Invest this year, I talked with the president of the New York Stock Exchange, Lynn Martin, and the expectations were that this was going to be a better year for M&A, for IPOs. Highly anticipated was Coreweave and some others that were substantial in terms of their size. So I'm just kind of wondering, is there something systemic going on in the IPO market? Or is it just, once again, because, right, give us some context in terms of the last few years.
So we're entering now the 4th year of very lackluster IPO offerings.
Right.
So ever since the market really got shut, late 2021, early 2022, you've had dribs and drabs. ARM has been terrific. Reddit has performed, outside of the pullback, all things considered, quite well. But when we've had 3 years of bankers and CEOs pointing towards the market not being there, even though we're at all-time highs. Now you're dealing with a market pulling back. A number of companies, early investors may be saying, hey, we penciled in 2025. We need to get this puck on the ice. And when Bloomberg Invest was playing out, the VIX was back above 20. We're back above 20 again. That's where people on the banking side look at as okay, maybe we should rethink this, or we need to be more diligent with how we price these deals and how we communicate to investors. But there's, as you mentioned, since March 14th, the market's been choppy. Klarna, StubHub, eToro, and Integrity Insurance have all flipped public. So they've opened the door to going public.
But go ahead, Ryan. I know
I
you're
was just going to jump in and say, I think it points to a wider question that's going on between investors, large, tier 1 investors in the banks around, what is the true quality of most companies trying to go public these days, and how much of a discount is necessary to get them over the line. I mean, we've talked a lot about, I think, on the desk, certainly around the nature of the IPO discount. It has narrowed, in recent years, but is there an idea that it could start to widen again, given some of the price pressure that we're seeing in some of these debuts?
I also think about, this is something I know you guys cover, and we talk about, Tim and I, the private markets, and just, again, there's so much cash out there. I mean, how old is Coreweave? It's been around for...
I think
They're young.
2017.
It's a younger company. All right. Because we have seen a lot of companies that are able to stay private for a lot longer.
I mean, look at Klarna, right? We talked about that the other day.
Yeah,
I mean,
this is like a company
is.
that's almost as old as Facebook.
Yeah.
It's wild.
Yeah. So it's kind of interesting. All right. So then what's the outlook? We got just about a minute or so left. I mean, Ryan, how are you thinking about this today and maybe what's to come? Or what are you hearing from
I mean,
Wall Street?
I think the point on private capital in general is a prescient one, because, there is someone I was speaking to this morning who was away from this deal that we're talking about today, and they're kind of saying, our IPO is again being seen as sort of the last resort, as opposed to a sign of strength. And, what does it mean for those who look to go? And, Klarna could, in theory, go as soon as next week, but are they?
Well, Bailey, you mentioned all these companies that in the last few weeks have flipped to going public. How much can they actually delay just in the last 30 seconds that we have?
There's no rule. So technically you can be on file for as long as you want. You just pay lawyers. To Ryan's point, Klarna, the earliest they could launch a roadshow would be Monday. So that's what we'll be watching. But again, tariff day is next week, and who knows what's going to go on.
Well, hopefully for your sake, for the weekend, I hope that doesn't happen.
Get a break, everybody. Right now, Coreweave just up a hair, so it's above 40, but it was just below 40 a moment ago. Guys, thank you so much. Bloomberg News U.S. IPO and deals reporter Ryan Gould and Bloomberg News Equities reporter Bailey Lipschultz.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We mentioned the stock actually in the last segment where we were talking about the Coreweave IPO, and that is Reddit. It's also on our radar today. The gloomy sentiment around the company has failed to dissipate after its shares fell 50% from a February high, with volatile technology stocks under pressure. A little perspective, as we like to do here at Bloomberg. Stock is up about 209% from its IPO, Tim, just about 1 year ago.
Okay, with the trade concerns and the outlook for the social media platform, here with us is Bloomberg News Equities reporter Carmen Reinecke. She joins us here in the Bloomberg Business Week studio. What happened? I mean, it had a great IPO, a great debut. And at the end of the year, things were looking really good. What's
Tim
happened?
Spends a lot of time on it.
Yeah, I actually spent so much time on it that, they do the Spotify Wrapped thing. Everybody does the Spotify Wrapped thing. Reddit had one, and they showed me like the data, like how much time I spent on it. And my reaction to that was deleting the app from my phone because I was like, I'm wasting my life with this thing.
They're sending you a hat, a T-shirt, a sweatshirt.
Enough about me, though, Carmen. What's going on?
Reddit had a huge run-up. It was a great IPO, great performance last year. Got really swept up in the AI wave that we saw across, the entire technology space for the most part. And then in the beginning of this year, its fourth quarter report fell just a little bit short of user figures. There was a change in the Google algorithm that sort of hit its US users. That actually seems to have abated, but what's happened on the other side is that it's gotten really weighed down in this overall tech momentum trade where we've seen so much volatility. I mean, even today you can see the Nasdaq's down more than 2.5%, and some of these highest flyers are really just getting dragged down. And so Reddit is a really good example of a stock where there is so much bullish sentiment. There's a ton of excitement, I think, for use with AI, like we were saying, large language models usage with Reddit. A lot of
they train using the data, so people have answered a lot of questions on Reddit. A lot of experts. That's what's great about Reddit. Reddit has then sold the data to the LLM companies.
Exactly.
And they train their LLMs using that data.
Exactly.
Okay.
And there's bulls also point out that there's a lot of growth potential markets here for Reddit, especially outside of the US. So it really is a good example of a stock that's just gotten really hit. And there are other examples as well.
So 15 buys, 7 holds, 3 sells. If I look at the Bloomberg in terms of analyst coverage, still a lot of buys on the stock. Are analysts, though, getting more negative on it, or do they still like the fundamental story but just think it's the tech malaise? What is it?
Yeah, so there was one downgrade recently, or an analyst that initiated at sell after the Google algorithm switch. But other than that, honestly, analysts have maybe tweaked their price targets a little bit, but they've maintained their buy ratings. They think that there's a long-term monetization story here, that there is a lot of growth ahead for Reddit. The one thing that I also think is interesting here is, and again, like the entire sort of tech momentum, I think people are a little bit hesitant of where to buy the dip or trying to call a dip, just seeing that there could be so much more room on the downside for a lot of these stocks that have really just gotten the wind taken out of their sails.
I will say like 14% of the float is still short. So there is still some negative sentiment out there that it could go lower.
For sure. Yeah.
I don't understand why Google would change its algorithm to show less of this, because people, and the cover of Business Week, of the upcoming issue of Business Week, is about what Google's doing in the face of the rise of AI and how people's search habits are changing and how Google's dealing with that. And one thing that the article mentions is that people started to change the way they search by adding Reddit to the end of their Google search, so it would then show Reddit results because Reddit results were so useful. It seems nuts to me that Google would change its algorithm and not show Reddit results with the same at the same place.
I mean, you make such a good point. I think there is sort of sentiment out there that, Google is going to lose some search, right, because of AI. And the other thing I will say is, like, they do change their algorithm on occasion. This is not like a new thing. So it's something that, for Reddit at least, hopefully has abated. It's something that they're used to dealing with, but it remains one to watch. It is really interesting.
Yeah, definitely. And as we said, still way above its IPO price, but it's certainly been under pressure. Good stuff. Thank you so much, Carmen Reinecke. She's Bloomberg News equities reporter.
This is the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I so love, because we're kind of cool about a lot of things.
Chill,
but
we're so chill and cool.
Give us a quiz, Tim and I, and man, it gets so competitive. All right, politics, economics, geopolitics, markets, business, culture, luxury, sports. We love all of it, don't we?
Yeah, we also love a Bloomberg quiz. A new one launching today. Here to tell us about the Bloomberg Pointed News Quiz is a big friend of the show. Really,
He's family.
We can say family, yeah. Former editor of Bloomberg Businessweek magazine, Joel Weber. He's head of Bloomberg Explains. He's here in our Bloomberg Businessweek studio. We love quizzes. We love games. I like beating Carol.
I like winning.
Pointed is different, though, Joel. This is not just like, what do you know? You got to know and be confident in what you know.
So, thanks for having me.
You're welcome.
Great to be back in the studio with you both. I love that you all are this competitive, and this is what we know about our people. Our people are highly competitive. We see that every day, and we wanted to give our super fans and even people who've never interacted with us a way of playing. Right? We have so many verbs that we do. We do watch, read, listen. Why not play? That's Pointed. So Bloomberg.com/pointed will drop you into the game. News quiz, 10 witty questions every single week, written by a trivia master. So this is not your normal news quiz.
Yeah.
And then on top of that, we've made the gameplay really distinct. Do you like to gamble?
If this is gambling, I like to gamble.
There's gambling, but the stakes are relatively
Right.
low.
We didn't lose any money in the process.
So you're going to wager points when you play.
Right.
And then you can use leverages to either amplify your score or hedge if you're not so certain.
How come there's only 3 though opportunities to do that? Because I kind of
you got to use them strategically.
I wanted them more.
Yeah.
Okay,
So
I see.
I'm curious. What was your score?
120.
That's good. It's
Thanks.
above average.
Thank you.
I got 115. Or no, I got 110.
Ooh.
Sebastian got 115. Yeah, Carol won.
And Sebastian
Okay.
got 115.
Yeah.
Our producers, Elizabeth, what did you get?
Hers was in the double
86.
digits, not the triple digits. That's what I'll say.
So we'll see how good it is.
It's like
based on-
bowling. The higher the
what
score,
did
the
you
better.
get?
It's not like golf.
So the high score is 190. If you play this game perfectly, you get 190. But
Wow.
the thing about this game that's unique is you can also end up with 190 negative, right? We will lose.
Right.
We will dock you points if you get your answers wrong. So I knew all the answers and I knew exactly how to play the game, and it was to test that we could do it.
Wait, so did you get
I was
you got 190.
There's a number of people who have played and aced it so far, so it's happening.
So is it basically like if you pick a category and go all in and then leverage that one at the highest? Is that how you do
have to
it?
learn how to play the game.
Sorry,
there's
did
a
I just
couple,
give it away?
No, that's how you play.
Okay.
And so we're eager to see everyone's scores. You get an awesome little readout at the end that shows how you played, and then the game is free to play. If you register on Bloomberg.com, you'll get a little readout that shows how you compare to everybody else. We're going to kick this off on Thursday nights from the U.S., and it's going to be open through the weekend. This is part of, accompanies the Bloomberg weekend. So it's more of a lean back experience. We want you to take your time, be thoughtful, make sure that you actually process the little hidden clues that we've, scattered across the questions for you.
I think people understand the leverage portion of it within the game, but before you actually play the game, you have to know what you know that week. So you're essentially given, 10 categories?
Yep, you got a wager.
It could be politics, it could be technology, it could be IPOs, it could be bankruptcies.
Yep.
And you got to think about what you know for that week.
And you're going to have a little slider that you can weight the category for.
So you have how many what's the ante that you have?
You have 10 categories. You can go down to 5 and up to 30, right? So you got a wager, whatever you want to put on the line there.
Okay.
Yeah.
So that's why
and it's going to add up to 100.
Right.
And then when you get to a point that you get the tease of the question, that's when you can use your leverages.
It's really fun. It was really fun. And I agree with Tim. Like, there's a lot of quizzes where you've got to be fast. That's part of like getting a higher score.
Yeah.
And it was nice to have some time to kind of play with it.
What we've cracked here is it's not testing whether or not you read your push alert, because most of us probably did that, or scanned the headline.
Right.
It's how confident you are in your answer. And that, we think, is a really uniquely Bloomberg thing. We're excited to explore more in this category. This is a new category for us, and we're really, wanting to prioritize, little habit-forming experiences like this.
Is there a lot of discussion that goes on beyond like what the questions are going to be? Like, is there something that happens during the week and you're like,
obsess over these questions? We've been doing rough draft after rough draft to make sure we get it right. And this week, maybe there was a certain messaging app that was in the news. Like maybe we want to ask a question about that. It's a pretty good way to get people to start playing and challenge each other.
I
got that one right, by the way.
There is another, dare I say, another quiz that comes out on Thursday, right?
But that's only for terminal users, right?
Big fans.
But
Quiz go.
But we will be like during the week, we're like, oh, that's going to be on the Bloomberg quiz. And I have a feeling we're going to do the same thing with this one.
Yep. And look, they satisfy different itches. Like one is very terminal centric, and you play it for speed and see how you can compare. And we're being a little bit more strategic with what we're doing on Bloomberg.com.
I love it.
Joel Weber.
Good to have you here.
The head of Bloomberg Explains.
And games.
Can you come back more?
Of course. We can do this every Friday.
All right. And don't look at the answers for next week. Oh, so then you can actually take the quiz.
Play it in a real way, Joel.
Yeah, come on. Enough of this.
I would be failing at my job if I didn't play it before.
Just saying. Little advantage.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, an update from, or on the war in Ukraine, I should say. An exclusive yesterday from our team at Bloomberg News. The U.S. pushing for a deal that would give it control over major future infrastructure and mineral investments in Ukraine, potentially gaining a veto over any role for Kyiv's other allies. This agreement would grant the U.S. first claim on profits transferred into a special reconstruction investment fund that would be controlled by Washington and would require Ukraine, Carol, to pay for all U.S. military and economic support provided since the start of the war.
Andy Kurtzik has kept a close eye on everything happening in Ukraine. It makes sense. He's the founder and chief executive officer of Just Answer, which matches you with experts such as doctors, lawyers, and mechanics, and more, who can answer your question. He has more than 300 employees in Ukraine. He joins us from San Francisco, the Bay Area, on this Friday. Andy, nice to have you back with us. How are you, and how is your team in Ukraine?
I'm doing fine. Thanks, Carol and Tim. Happy to be here. And yeah, it's tough in Ukraine. The situation has changed dramatically over the last few years.
Well, Carol asked how your team is doing, and it's a complicated question because you have more than 300 people there. But since we last spoke to you, has the team had to take breaks to go and actually fight in the war? How has that worked?
Yeah, I mean, our people are getting drafted and they are going to fight in the war. This war is a meat grinder and it is killing lots of people on both sides, and they need to keep bringing in more people to fight the war, and that includes our employees, including
Andy, those who work for you. Have you lost any members of your team?
We have. It's tragic. We have lost members of our team. A wonderful guy that I worked with closely was killed, and it's a tragedy.
Oh, I'm so sorry to hear that. It's absolutely awful. As I mentioned, it has been a few years since we spoke to you. We spoke to you right at the beginning of the war. Certainly, a lot has changed, including a presidential administration. How have you been watching the way that the U.S. has shifted its view in this administration on how to support Ukraine and end the war?
I mean, it's a complete 180 shift recently with the Trump administration's approach compared to the Biden administration's approach to Ukraine. It is quite a lot of uncertainty right now, and a lot of fear and concern in Ukraine for what might happen.
One thing that we spoke about when we last spoke was the talent in Ukraine, especially on the computer science, programming, engineering side. For years, American companies have tapped into the talent there for jobs that have been hard to fill here in the U.S. a lot of companies decided not necessarily to continue with their operations in Ukraine as a result of the war. You did, though. You kept your team intact. Explain the reasoning there.
Yeah, so supporting Ukraine is incredibly strategic for us. I mean, these are bright, talented, hardworking folks, and they help. Without them, we wouldn't be able to be where we are today as a company. And so we've really doubled down on supporting them, and it's both smart from a business perspective, but also I think beyond that, it's strategic from a global perspective. We're investing in the future of democracy and the future, I think, a future innovative partner in Europe.
What did you make of when Tim, kicked off the introduction to you, talked about, the negotiations that are going on, U.S. involvement, looking for control over major future infrastructure, mineral investments in Ukraine. How do you read that?
I mean, it feels like it's gone from an incredibly strategic perspective on the world democracy and really thinking about the future of all of our allies and encouraging democracy to more of a negotiation and a business transaction. And that's difficult to watch.
Is it also difficult to watch? And I think about some of the optics that some have mentioned, certainly during the inauguration of President Trump, second time around, of very prominent members of the U.S. tech community. And I am curious what you are hearing from some of your peers or others in the tech community about the lack of support that might be coming from some very prominent individuals who could maybe help Ukraine in terms of the future.
Yeah, that has been difficult to watch as well. A couple of years ago, the whole world was on Ukraine's side, and everybody was rooting for them, supporting them, and encouraging their fight for democracy, which is really a fight for us. And it has been disheartening to watch that evaporate over time, and many of those same leaders that were staunchly in favor of Ukraine and out there promoting, Ukraine's democracy are now quite silent on the topic. And so, that's exactly why I feel it's crucial for me to speak up. This fight isn't over. Ukraine's struggle for freedom is a marathon, not a sprint. And, I believe the tech community, known for its innovation, should be standing up and persevering with Ukraine to help them win. So my message to my peers is stay engaged. This is good for not just your business, but it's good for the world.
What hope do you have that you can get the support that you need from Europe itself? Because I think there are some who would say, okay, this is in, the European Union, it's their backyard, they should be stepping up more. Are they? What are you seeing in terms of support from other European nations in terms of this ongoing war now in its third year?
So this is an incredibly strategic battle for the whole world, for democracies everywhere. So it is about not just the U.S., it's about Europe as well. And I am seeing positive signs that Europe is stepping up more and doing more to fill the void that the U.S. has been expanding in terms of the support. So I am hopeful that Europe will step up more and do more.
Mm-hmm.
Andy, I want to shift just in the last couple of minutes that we have to talking about the business Just Answer and get a business update from you while we have you. I'm curious how you're incorporating AI, something that we're spending a good portion of our lives using and talking about at this point. How are you incorporating it into Just Answer?
Thank you. That's a great question. We love AI. We've been using AI for about 12 years in very important ways. So the way that AI works at Just Answer is that we think about the professional services experience, going to see a doctor or a lawyer or a mechanic or an accountant or a veterinarian. And we essentially took that entire process apart and reassembled it in an AI first way 12 years ago, so that everything in that customer journey, except for the human answer, is automated using AI. The intake, the triage, the follow-ups, so everything you can imagine is automated using AI, except for the human expert answer. And so that's really driven a lot of growth for our business.
Is there a way though is there a way to automate that human answer? I think that's sort of the natural next step for your company, is that the answers to the questions exist online in some form already. No?
Sometimes they do and sometimes they don't. So, as we know, first of all, we have a product, a division called Pearl.com that is giving AI forward answers. So we have a front row seat on that experience as well, and actually giving expert answers via AI. Our system is 22% better than ChatGPT and Google Gemini in the professional services sector and 41% less wrong. And yet people still prefer to talk to a human expert for many reasons. First of all, these systems all hallucinate. Ours is better than ChatGPT and Gemini, but it still hallucinates. And that's just a fundamental problem with these foundational models. They make mistakes. And when you're talking about a poem or help me write an email, you know what you're doing. You can deal with that. But when you're talking about a medical issue, a legal issue, right? These things have high consequence, and the quality is critical. And you're even seeing companies getting sued now, Google included, for giving bad advice.
Yeah, that's a good point. Hey, Andy, always good to check in with you. Andy Kurtzig is the founder and CEO at Just Answer. He joins us from the San Francisco Bay Area.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we've got about 18 minutes to go until we wrap up the trading day on this Friday and wrapping up the week overall. As we've been reminding everybody, you just heard from Bill Maloney and Charlie Pellet. We're pretty much near our lows of this session. We've stayed there really for the last hour, it feels like, that we haven't been able to see any kind of rally potentially into the close here. Still down about 2% on the S&P 500. Dow Jones Industrial Average, a decline of almost 750 points, down almost 1.8%. The tech-heavy NASDAQ 100 down almost 2.8%. That's a decline of almost 550 points. But we are seeing really some broad-based selling. I keep bringing up the equal-weighted index for the S&P 500 just to see where that is. As I mentioned, the S&P down 2.1%. The equal-weighted S&P 500, Tim, still down about 1.6%.
Yeah, I'm taking a look at a deeper dive into the different industry groups. Communication services down 3.9%. Consumer discretionary down 3.6%. The Bloomberg gauge of Mag 7 is underperforming everything right now. It's having its worst day going back to March 10th. This is the Bloomberg Magnificent 7 Total Return Index. It's down 3.7%.
All right, let's see what our next guest has to say a little bit about this market environment. Rob Thumel is Senior Portfolio Manager at Tortoise Capital. It's got $9.6 billion in assets under management. He helps manage the Tortoise Energy Infrastructure Total Return, ticker is TORIX. It has returned more than 38% over the last year, putting it in the 95th percentile among its peers. Go back about 3 years, averaging about 20% per year, putting that in the 69th percentile. He joins us now from Kansas City. Hey, Rob, before we talk energy and other sectors, broad view on today's environment, market environment, and the selling that we continue to see on this Friday.
Yeah, good afternoon, Carol and Tim. Obviously it's been a rough week. Obviously, tariffs and uncertainty regarding the impact of tariffs on the economy are driving everything. And so that's what we're seeing across the board. I guess the good news is, as an energy investor, and that's what we focus on at Tortoise, the one thing that is certain, we always need more energy in the U.S. and always need more energy in the world. So that's been a good place to be.
Is it concerning at all to you, given that energy prices are volatile in terms of supply and demand, mainly demand, not just here in the U.S., but also globally, if we could be entering a period of perhaps a recession?
Yeah, Tim, and that's a good question. So energy demand and the economy go hand in hand. So if we do have a recession, energy demand does go down, but it also comes back, and it comes back fairly quickly. So if you go back and look over the last 40 years, global energy demand has risen 38 out of those 40 years. So do we watch it pretty closely? Yes. But when we look at where do investors look to put cash, one of the great things about the energy sector is there's a lot of companies out there like energy infrastructure companies that have fee-based cash flows, and they pay high dividend yields, right, to investors. And that's a good place to be in these uncertain times, because these dividend yields are certain, the cash flows of these companies are certain, and so we like those type of plays in this type of a market environment in the energy sector.
And there are some specific companies, because I do think in an environment like this, there's always buyers and sellers. It's just a matter of price, right? And you do like, and we do see it sometimes an investor at this point saying, well, wait a minute, there's a name I like the fundamentals, I get it. Maybe it's a longer term hold because of the uncertainty in the current environment, but nonetheless, I can maybe get it at a cheaper price in this environment. But let's get to some of your individual picks that you like. Williams Companies is among them. Ticker is WMB. Why this name in particular?
Yeah, no, Carol. So if you think about this from just a big picture perspective, we think that natural gas the energy sector is being redefined. We think in the next decade or so, and natural gas will play a really important role. And so all that ties back to Williams, because Williams is one of the operators of the largest natural gas pipeline networks in the world. So once again, they're one of these companies, pretty high dividend yield, 5% dividend yield. They're going to grow that dividend 4 to 6%, might even be a little bit higher than that out into the future. They're really benefiting from a lot of different things that are going on in the U.S., whether that's exporting of liquefied natural gas out of the U.S., whether that's bringing back manufacturing to the U.S. That's really important. But the big change is AI and the development of electricity demand that's really needed to support the development of AI and all these data centers. And Williams will benefit from that.
How do you look at, and you have a couple more picks, we're going to get to them, but I'm just wondering how you look at renewables and whether or not there is a future in renewables, given what we've seen from the Trump administration.
Sure, Tim. Well, we think there's an all of the above approach that's going to be necessary for energy demand. I think if you just look both domestically and globally, energy demand's going up, and we're going to build a lot of data centers. I know that this data center trade is I guess being called into question, and maybe some CapEx is going to be a little bit lower, maybe it's going to be a little bit higher down the road. But the big picture is we're going to need a lot more data centers in the U.S. We're probably going to build this equivalent to the strategic data reserve, kind of like we have the strategic petroleum reserve in oil. We'll have the strategic data reserve for technology. That just means you're going to need a lot of electricity, and you know what? You're going to need a lot of energy. And so we're going to need all of the above approach. Renewables will play a role in that, but natural gas will play a really important role, and probably one of the most consequential roles going forward.
Hey, since you are so embedded into the energy space, what is your longer term view on renewables? Is it a rollback? Will we not see the investment? Is it a 180 turn for the United States? Or, the train has already left the station and renewables has to be a part of our energy story going forward and will continue to be maybe even more so?
Yeah, I think well, part of it's the technology. So I do think that the technologies will continue to get better. Obviously, we're looking. The wind energy has struggled offshore for sure, as far as the technology becoming a commercial operation. But wind energy domestically will continue to grow. We think solar energy will continue to grow. Hydrogen will be a little bit tougher. The economics right now are really tough for hydrogen going forward. But carbon capture has the potential as well to really change the game and improve the environment and the environmental circumstances pretty substantially, probably over the next decade.
Okay, we only have about 30 seconds left, but I want you to give us just 30 seconds on Energy Transfer, ticker ET.
Yeah, ET. So it's a great company, diversified energy company, almost an 8% dividend yield, going to grow the dividend 3 to 5% a year. It's a classic American entrepreneur story run by an entrepreneur, Kelsey Warren, or founded by Kelsey Warren. It gives you really exposure to energy infrastructure, so fee-based cash flows, and exposure to exporting of crude oil, exporting of natural gas liquids like ethane and propane as well. So it's a great opportunity to get some yield.
20 seconds left here. Are you nervous about this market environment? Are your investors getting nervous, running for the exits?
Not ours, because of the dividend yield that we can provide, right? The energy's underperformed in so many markets, Carol, and as you know, energy's coming back, and actually we're seeing a rotation. There's a rotation out of tech into energy. Energy is one of the best performing sectors in the S&P 500. When we wrap up on Monday, I think it might be the leader, and so as a result of that, we're excited about where the world can go with energy.
All right, have a good weekend, Rob. Thanks for your time today. Rob Thelmel, Senior Portfolio Manager at Tortoise Capital.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.